The code says leave banking to bankers. We challenge that.
The code says only pros can invest. We challenge that.
The code says banks don't care. We challenge that. We love numbers! But we don't treat anyone like one. We become strong by making our clients stronger. And that's why we challenge the code.
Good morning. I'm Dana Baltaji, the team leader for FX rates in EMEA for Bloomberg News based in London. And I'd like to welcome you to day 2 of this special virtual series, Navigating Markets 2020. Now, today, we're going to discuss the future of asset allocation and the changing shape of trading while global markets continue to feel the effects of the current health crisis. And in this climate, investors are considering their future options and are rethinking the long-favored 60-40 portfolio allocation formula. But of course, that's just one of many changes happening this year. I'd like to start by thanking Swissquote Bank for their support in making this event possible. Please make sure to check out the Swissquote institutional brochure notes on thought leadership, which you can download from the agenda tab. Now, before we get started, we have a few housekeeping announcements to ensure that you all enjoy the program. For today's event, we have partnered with Thiston, an audio-to-text platform that's transcribing today's discussion in real time, making the event even more accessible. You can access Thiston for real-time transcription via the link in the session description. If you experience any issues at all with audio or video quality while viewing, try to refresh your browser or use the chat box in the bottom right corner of your screen for support. Now, this is an interactive event, and we welcome your questions, of course. And if you want to submit one, just you could write it out in the white box on the right side of the screen. Please include your first name and the city where you're based when you're writing your question. But of course, you can also join the conversation via social media, and we would encourage you to follow us on LinkedIn or Twitter or Facebook using the hashtag Navigating Markets. All right, let's start by introducing our first panel of speakers. Joining us this morning, we have Jane Foley, the head of foreign exchange strategy at Rabobank. We have Christoph Hook, the head of multi-asset trading at Union Investments, and Eden Simmer, executive vice president and head of global equity trading at PIMCO. Thank you so much for joining me today. All right, let's get started. Eden, this question is for you. So there were quite a few compliance issues that hindered some traders from working from home before the virus forced us all into lockdown. What was the biggest issue? And how do you think overcoming that issue has changed the financial industry as we know it?
Sure. I think that we're all fortunate enough to be part of large institutions where we had detailed scenario planning in place, ahead of the lockdown. In the case of trading, one of the biggest compliance issues that came up, and it didn't really come up, it was just something to think about, was changing the way that we're actually communicating trades and communicating with the street, and making sure that the executions that we're doing in real time are done over mediums that can be audited, that can be recorded, so that there's a nice audit trail to go back on and be able to reference, especially when markets are as volatile as they are. And so with that, I think part of that scenario planning, I don't think any of us expected, at these institutions when we go through these BCP processes, that any of us expected to, enact it at this scale. So, getting that set up at first, and getting through the communication, making sure that the traders, confirm again that we're speaking with the street who themselves were spread out to different disaster recovery sites. That was something that, was a little bit of a bump in the road, but at the same time, it was necessary, and we were able to get through it rather smoothly.
And now that we have, and we know that traders can work from home, what sort of changes do you think will happen in the industry? So for instance, will we be seeing more women in the industry?
Yeah, no, that's a great hope. I think that what it really did is, we all sort of needed this scenario where we were able to break down the structural legacy issues surrounding trading, which was, being in office, very restricted formal hours, And because of the pandemic, we all kind of learned that we can operate from home, we can communicate efficiently from home, we can trade from home. I think in that way, it does really open up the industry. It opens up the field to more diversity, to more gender equality in the industry. Especially with people who face a lot of the hurdles, but not being able to, we all in this industry had kind of inherited long time, I guess, habits, you could say, from days of old, and now we've seen that playbook thrown out the window. And now that we have sort of a new playbook, maybe it's not going to look, everyone working remotely. But at the same time, it does offer more flexibility, and more flexibility offers opportunity for more diversity.
Jane, in our discussions previously, you had quite a bit to say about this. Is there any other shift in how you see the industry is going to look because of the fact that working from home seemed to have worked?
Well, I would really agree with the point that I think this can be a point of change. It's really quite interesting because, I've been of the view for the last few months that, when they do bring us back, perhaps the traders will have to go in first. But I was talking yesterday to one of our head of our trading desk, and he said, well, why should that be? It's proven that we can work from home. Everything that we do is being monitored. And why should, some of the traders who perhaps like that flexibility, who want to be at home for longer, maybe those who've got young children or other caring duties, whether be they men or women, why should they be told, well, you have to be back in the office, but somebody like me, perhaps in research, can stay at home? And I think HR really will have to look at this quite differently, and they will have to sort of re-examine what people actually want. And if they want some flexibility, well, maybe they're going to have to give it to people, irrespective of their market function. And that, I really am hopeful, will help to bring all sorts of different diversity into the market, not just women, but maybe people with perhaps some sorts of disabilities, visible or invisible, and people from a much more diverse range of backgrounds. And I think that could really bring some more creative thought and really help open up our markets. So I'm quite hopeful about this.
I mean, those are really good points. And there's also, of course, the other side of this coin. If, for instance, people are working from home, then they don't need to be, maybe they don't need to be as well compensated, for instance. If they're not living in central London, does that then open up the possibility for, let's say, a cut in salary?
Well, I think we've seen already in California one tech company saying to people, well, look, if you're not based in California, if you're based somewhere else in the US where your cost of living is less, well, you maybe you should be being paid less. Now, obviously, the employment laws in different countries are quite different. I would imagine that we're not going to see that immediately in London, but you can imagine a shift. If people value perhaps an extra half hour, 40 minutes, an hour in bed over a commute, if they value perhaps being close or living close to an open space rather than in the city, maybe they would be prepared to be paid less. I mean, certainly their housing costs may be less. They may be spending less money on a day-to-day basis on travel, on lunches, on clothes, etc. And maybe they would be prepared to take a lower wage to work away from London, to work more flexibly. So I think over time, I think that possibility will open up.
Yeah, I think I would just echo agreement there. And in addition as well, I mean, it's just a reprioritization of what priorities are, right? In terms of, the work-life balance and what it is that we can offer, our employees and our traders and people in the finance industry. I think when you see with the rise of the passive investing anyways, you're seeing fee compression across the industry as a whole. And so perhaps some of that resetting of salary compensation expectations is already happening. And this just gives another methodology of retention, of recruitment that we face going against the tech sector, where people can make, more informed choices about how it is that they want to live and how they want to live and work and balance the two.
So it kind of feels like as though the virus helped to accelerate a trend that was already in motion. Is that something that you're seeing as well, Christoph?
The same we experience. So I just can echo what Jane and Eden were saying. So prior to the COVID-19 crisis, we were set up for working from home. Given the fact we are a global asset manager, but we are predominantly here in Frankfurt based. So from a trading standpoint, we cover all 3 time zones, the Asias, Europe, and Americas here out of Frankfurt. And already in the past, we were making use of working from home, of trading from home. So therefore, it wasn't a big radical shift for us, because most of us, we've had already the equipment, notebooks, monitors. We've had taped lines when talking about compliance. This was one of the key topics. Also here, that you don't make use of your probably non-taped mobile when talking to broker firms. But we have replicated exactly the same infrastructure we have here in the office when working from home. So yeah, therefore it's something we were already used to do, but we just rolled it out to the entire traders here in our Frankfurt office. At the moment, we are in a situation where about 40% are working here from the office, and 60% of the traders are working actually from home. So isn't there a scenario where I can imagine that all traders, for potential quality of life reasons, work from home? Definitely not. So we as a firm, we clearly see the benefits also from a cultural perspective. That we have a decent proportion of our employees here in the office. So therefore, the post COVID-19 world definitely will look different compared to what we've experienced beginning of 2020. But can we imagine there's a situation that you have 75, 80% of your employees working from home? That's definitely not the case. As I said before, cultural reasons, also for the sake of communication, it's helpful to us here in the office, and I think we will make the best out of the 2 worlds in a post COVID scenario. That on the one hand, we learn to make use of the higher level of work-life balance due to the bigger flexibility we have right now. But on the other hand, we also know where our office premises are, and we are happy to get back here to the office.
Well, thank you very much for that, Christoph. Jane, I have a question for you from the audience, so to speak. The question is basically, the US dollar now seems to be in early stages of a downtrend. They're wondering whether or not this is going to be a longer term trend. And what does this mean for oil? Sorry, not oil, gold.
For gold. We've seen the dollar really been in a bear trend really since the spring and the summer. It's built up a lot of momentum, and I'm sort of worried about that momentum trade, if you like. Sometimes when we have a lot of momentum, we can fling bad news at it and it will bounce off the trend until eventually the market does absorb it. And I'm concerned right now. We are in the midst of a pandemic. The market appears to be short the dollar. It does have a safe haven appeal, and I'm wondering whether or not we will see people really covering their short positions, given we have a winter coming up in the Northern Hemisphere. The cases about COVID-19 in Europe and the US are not improving, at least not yet, and that is a concern. And also we've got to remember other G10 central banks. The euro likely was dampened down last week when the ECB indicated it would ease again in December, and you've got various other central banks talking about negative interest rates. In fact, the Fed is an outlier here. It's the only G10 central bank which has deliberately turned the conversation away from negative interest rates. So, I'm not so sure that this momentum trade towards dollar bearishness will hold up, given the market is already short.
Okay, thank you very much for that. Christoph, I have another question for you. Has the pandemic and all of the central banks stimulus changed the way investors look at the all-important 60-40 model? And if so, how?
So thanks, Dana, for the question. So what we've experienced in March, April was after a massive sell-off in risky assets, a very fast reaction from various governments on the one hand, looking at stimulus, and on the other hand, also a global coordinated activity action from central banks. And this is something which was completely different when comparing the COVID crisis we've experienced to the 2007, 2008, 2009 financial crisis, because there was a very compared to today's reaction, there was a fairly slow adoption of central bank support. And I think due to this very rapid action we've seen in 2020, we had a massive risk on after the sharp acceleration to the downside. And so from our perspective, and we've been obviously also here in communication to central banks, we've been in communication to various ministries of finance. Markets held at a pretty stable level, and as I said, we've experienced a massive risk on after couple of days where we experienced uncertainty in markets, and especially in credit markets, we've seen it around mid March. That markets started to become stuck. So we were close to a scenario in 2008, but as I said, thanks to the very quick reaction, we went into a risk-on mode. Therefore, from a portfolio composition perspective, to be honest, not really. A lot has changed. So we as Union Investment, we have on the one hand dedicated equity mandates, we have dedicated fixed income mandates, we have multi-asset mandates, and there were plenty of opportunities to outperform our benchmarks. And so therefore, from a strategic standpoint, the answer is no change. We navigated extremely well through the month from March till June, where we've had very high level of volatility across all asset classes.
Okay, thank you very much for that. And in this very low yield environment, I mean, I'm seeing Italian yields at near record lows again. I'm seeing Spanish 10-year yields less than 10 basis points away from 0%. Is that having an impact on demand for equities, Eden? Do you see that there are more people that are interested in going into stocks?
I think you do. I think, I think especially if you look at the sort of the retail investing, trends that you've been seeing. And first of all, the market is more accessible in equities than ever for people to invest in. I also think too that, given in a situation of a highly volatile market, people seek transparency, people seek safety, people seek, what I mean? Places where they can transact it and have a lot of safety and regulations around that, and equities as one of the most regulated asset classes in the world, I think provides that. In addition, you see all these retail brokerage firms, with the fractional shares, zero costing models. And what you're seeing as well in the fixed income market is you're seeing, sort of the equification of fixed income, or by fixed income ETFs, and the explosion that you're seeing there, and how investors are accessing the fixed income markets via an equity wrapper. So yeah, I think you are seeing, people, come into the equity market, new participants come into the equity market. It certainly is changing the landscape. It's changing, price action, price discovery, momentum, liquidity conditions. And with all of that too, presents opportunities, dislocations that smart investors can really track and take advantage of from a trading standpoint. So to answer your questions, I think absolutely yes. You're seeing more different types of participants come into the market, and more investment come into the market.
And actually, that brings me to my next question quite nicely, Jane. This one is for you. So, one of those investors that has been coming into the market more, of course, is retail investors. They've become a formidable force, especially in stock markets, but also in FX. And there seems to have been a similar trend after the global financial crisis. And what is it about a crisis that brings retail investors back into markets?
Oh, I think it's just the news headlines. So it brings people through, it links them up into interesting headlines, and they see the volatility, they want to get involved. But I mean, I suppose first of all, I should put the disclaimer with respect to foreign exchange. The foreign exchange market is so liquid, it's so deep, and according to the Bank of International Settlements, the latest data that they had for last year was that on a daily basis, we're seeing flow of $6.6 trillion. So given that huge mass of trades that have been done, the retail investor probably isn't making an awful lot of difference in foreign exchange, but they are becoming more engaged. And you're right, I think this has been something which has happened since the global financial crisis. Really did engage people in the volatility in the markets, the huge movements that we were seeing back then. But it coincided with with the technology growth. All you needed at that point and subsequent was really an internet access. You needed Wi-Fi, you needed a laptop, and you could be involved. And you had a variety of providers coming online, offering really a cheap way to push in, and various different products. Spread betting in foreign exchange, a cheap and easy way to be involved. You also had, derivatives that people could get involved in, CFDs, for instance. Again, quite a low-cost way to be involved. And of course, in recent years too, you've seen more about robo trading, and you've seen banks, for instance, in the UK, there's a small bank called a TSB. It used to be owned by Lloyds. I'm not sure if it is anymore, but you can be a TSB customer and you can invest in a robo trade. It's very quick. It's very simple. They've linked up with a company called Wealthify. I had a quick look actually this morning on their internet site. It's really easy. You pay a very small fee and you just tell them whether or not you want to take a big risk or a small risk, and an algorithm will invest you, and you can track it. It's so simple. I can see the attraction really for an awful lot of people, and they have access to the algorithm that perhaps before they would actually have to pay a physical person, an investment advisor, to access. And this, of course, brings down the cost. So I think really it's just easiness of it, the attraction of it. Perhaps people who like a little bit of gambling as well, they want to get involved. So this is, I think, going to be increasingly a very significant part of the market. But it does come with costs. And I had a look this morning on the website of one of the FX providers, and there was a big banner across their screen, and they said that 74.74% of retail investors lose money when trading CFDs. I don't know what the statistic is offhand with foreign exchange, but I have known it in the past, and I do know that retail investors lose money on spot investments. So, this is something which I think the government and the regulators are going to be watching quite closely going ahead.
Well, this actually brings back the point that Eden was making, which is that there seems to be like a move towards more passive investing and so on with these algorithms that retail investors seem to have access to. But can I just know, do you guys feel like, with the rise of the retail investors in the stock market, that it's changing the way that even an institutional investor would look at the stock market?
I mean, go ahead, Christoph.
Oh, please go ahead. Thank you.
From our perspective, anytime you introduce a new market participant in a real way, of course, institutional investors are going to have to take heed and notice, especially when liquidity conditions being what they were in March and April and May, where the liquidity one-sided momentum, things going the way they were. I think you had a situation where in the one of the most liquid futures, contracts in the world in equities, which was the S&P E-mini, you were seeing, top of book depth at, maybe 2 to 4 contracts, when historically it was around 120 contracts or 150 contracts at a given point. And so in that kind of instance, you really need to pay attention to trends and see what the underlying, even in single stock names and sectors, what the underlying trends are, who's participating, because the PMs want to know who's driving the moves and why those are being driven. And so when you introduce, new participants such as retail investors, it's really important to try to understand how it is that they're trading. As we said before, a lot of it is off of volatility, a lot of it's off of headlines. So if news flow is driving more and more of this, insane price action, again, that also gives opportunities to take advantage of dislocations as well.
I think, Dana, it's in general important, and that's applicable for all asset classes, not only to look at the fundamentals, but also from a market intelligent point of view, so to say, to look at flows, to look at positioning, to look at sentiment, looking at in derivatives world at volatility, at gamma positioning, to fully understand markets. And I can echo what was said here previously, that retail, also when it comes to US stocks, a couple of months ago was really a dominating force. And I remember days where I was talking to broker firms discussing this phenomenon, and these were days where retail flows for large bulge bracket firms were bigger than flows generated by hedge funds. And therefore, as I said, to get the full picture, it's really important also to look at retail flows. And adding to what was said before, I think there's a kind of tactical component when looking at retail, but there's also a kind of strategic component. So technical component definitely is driven by the COVID-19 situation. You don't have a sports event anymore in the magnitude you've had it prior to COVID-19. So lots of retail investors in the past betting on various sports events. That's what we've experienced. They shift their activity into the equity market. You've had in the US, but also in other jurisdictions, you've had paychecks. Where a good proportion of this money also went into equity markets, and that's from our perspective the kind of tactical component which might change when we have a post-COVID-19 world. But the strategic one is the topic of tokenization and digitalization, and that's something which doesn't which will not go away anymore. So. Investors, and they can make use of their smartphone. They can, just by having a few clicks, and they can buy and sell stocks or other assets. That's something we haven't had 20 years ago. I remember here in Germany about 10, 20 years ago, when you intended to buy a single stock, you've had to fill out pages and then read contracts 20, 30 pages long. And these days, it's just accepting the general terms of an app. Just click I accept, and you are done, and you can enter the market. And additionally, what has changed also compared to the past, you can buy these days fractions of shares. So you don't need to pay $400 for a Tesla share, but you can define, I want to invest $10 in Tesla, and that's also something which has changed significantly compared to the past.
That's a really interesting point, the fact that now, the fact that you don't have to buy an entire share allows people to participate in markets more. I do have a question from the audience. This is a little bit backward looking, but I think worth asking. The question is, isn't there also the case that institutional investors just didn't read the markets well during March and April? I leave that to you guys to decide who will answer.
I think you can definitely you can say that certainly not everybody would have made money in that period, and perhaps for an institutional investor looking at the stock market, the headline news was talking about a pandemic, which you would imagine that there was going to be disruption for demand, there was going to be disruption for supply, and in that case, it was going to make it potentially very difficult for a lot of companies. But of course, then what came in was this huge amount of stimulus. We had fiscal stimulus from various different countries, and of course, monetary policy. And we know that stock markets generally like cheap money. And then you had the retail investor getting involved. The Robin Hood, I think, was one that was in the headlines. Then a huge amount of young investors. I think the average age of investors in Robin Hood is just 31. So you had millennials, you had Generation Y or X coming in and really getting involved. And I think this comes back to this concept of the savings glut. And I think this has been really important for investors and for the markets over the last few years. It's something that Bernanke, the previous head of the Federal Reserve, has talked about really for years. We have the savings glut, we have an Asian savings glut, and money has to go somewhere. And of course, people are looking at their bank account and thinking, well, I'm not going to get paid in my bank account. I'm not going to get paid in fixed income. And they have deliberately been pushed, if you like, because of the lack of yield elsewhere, into taking riskier assets such as stocks. So they've been looking for value, looking for stocks. And I think for some investors, because stock markets have been going higher, the last few years, they don't necessarily perceive these as a risky investment. That they've done well in stocks before, they anticipate that they will do well afterwards. And I've certainly noticed a lot of older people who certainly the textbooks would have recommended, well, they should be invested in fixed income, into safer assets, really buying into stock markets purely because they've made gains there in the past. So I think there's a huge amount of money is looking for a home, and stock markets are where people see that. And I think for institutional investors, maybe it just took a while to catch up with some of these trends.
Wonderful. Thank you so much for that.
Something,
Sorry,
Dana, it's something we also experienced here. Thanks, Dana. It's something we also experienced here at Union Investment. So during March and April, we have had inflows in terms of AUM from our investors, and this were inflows coming from retail and also from institutionals using the opportunity to increase their exposures here. And we have especially seen, that's what we discussed beforehand, we've especially seen inflows into the equities area, but also into credit when it comes to fixed income.
That's wonderful. Thank you so much for those insights, Christoph. And thank you to all of our speakers. This has been an amazing discussion, and it's been very informative. Next, we are going to hear from Bloomberg Intelligence's Senior European Strategist and Director of Research and Content, Tim Craighead. He has a short presentation on the topic of considerations for equities, fixed income, and currencies.
Good morning, everyone. My name is Tim Craighead, the Senior European Equity Strategist for Bloomberg Intelligence and one of our Directors of Research. In the next 8 or 9 minutes or so, I'd like to take you on a bit of a whirlwind tour and offer a couple of considerations across major asset classes from our team of strategists here in Europe. If you can move forward to the first slide. What I'd like to start off with is equities. It's my home turf, so we'll get moving from here. And what I'd like to think a little bit about is what is driving the European equity market from a broad-based perspective. And you look at this top panel, what you see is the Stock 600. And I've highlighted the areas where we've had major positive moves in the equity market. And down in the lower panel, what we're looking at and we've highlighted are the key drivers, whether it be earnings or whether it be valuation. from the standpoint of what has propelled the market to higher levels in these periods. And certainly as we look forward, and typically within that context, you can see it's either one or the other. It's very rarely both earnings and valuation. What we expect as we look into 2021 and into 22 is that valuation from current elevated levels is pretty much run its course. We do think it can stay elevated because of lower for longer rates. I'll come back to that in a moment. But the market has to be driven by earnings. And we do anticipate an earnings recovery as we look forward. But this will segue, if you can flip to the next slide, to a critical theme in the European markets. And that's one of cyclical versus defensive positioning. If you look over a period of time, and this is a window of 5 years, we could extend it further. Cyclical versus defensive relative performance tends to move in multi-year waves. And at this point, we think that we're moving into a period where cyclicals will come back into favor after a couple of years of underperformance. This will be driven by relative earnings. It always is, as you can see in the bottom panel. And the only caveat that I would add to this as we look into 2021 is that we do think that there's going to be a bit of a pause from the standpoint of the relative earnings advance that we've already started to see from this spring in favor of cyclicals due to current European restrictions and potentially more of the same coming in the US in just the next few months. So from an equity perspective, bottom line, we think earnings are key. And we think there's a cyclical story to be told. The question is, when do you take that wholeheartedly forward? Well, let's shift to the next slide and think about the world of credit. It's an interesting sort of dichotomy here that our credit strategy team is thinking about. You can see with the blue and the yellow lines that clearly leverage is moving up. The intriguing thing, which rarely happens as leverage is elevated, is that yields are well contained, actually quite low. Clearly, this has a lot to do with central bank activity. We'll come back to that in a moment. Now, if you flip forward, what we're seeing, interesting enough, is from the standpoint of upgrades and downgrades. We had seen multiple years, both for high yield and investment grade, a move towards upgrades. And clearly, that took a bit of a nosedive early this year with the pandemic. That was through first quarter, second quarter. In the third quarter, you can see that things have started to improve with upgrades ticking up ever so slightly. Now, again, similar to what I talked about with the cyclical defensive element in earnings in equities, credit may fall prey over the course of the short term for renewed downgrades. But we do think that that's likely to be short-lived as we look further into 2021. And it is interesting to note that fallen angels have essentially evaporated over the course of the last month or two. Now, as we look ahead and flip one more slide, what you'll find is the ECB is all over the developments within the credit market. We've seen purchases advance markedly with the pandemic purchase plan, and we do think that there is more of this to come. The little blue line shows the percentage of corporates within the total QE activity, and certainly you saw that dip earlier this year because the focus was on sovereign credit purchases. It's started to tilt towards corporates, and we think there is more of that to come. I'd also mention that corporate credits tend to outperform, I should say, tend to recoup crisis period losses in the following year. And this is a quite consistent theme for both in investment grade and high yield, and we think that will be the case going into next year. Now, lastly, in credit, if you flip one more slide, slightly different take. The world of green credit, it is developing. It's rapidly expanding off of a small base. Europe is leading the march, undoubtedly. And interesting enough, China, as small as that credit market happens to be, is outpacing the U.S. By a little margin. We do think that there is more to come next year for a whole host of initiatives that you all are I'm sure, quite familiar with, and Europe will maintain a leadership position. Now, let's shift from corporate credit to sovereign credit. If you can move one more ahead. Similar to what we just talked about with corporates, ECB action in Europe has its fingerprints all over the place. And I take a step back. The beginning of 2020, there were about 180 billion euros in issuance that was expected. As we sort of wind the year down, it's turning out to be something north of 1.3 trillion. So clearly a magnitude larger. The same thing happened back in 2008 in the financial crisis. And there, central banks in Europe were not all that in play. This time they are. And if you look at the last column in this upper table, you'll see that only something north of 300 billion has had to be absorbed by the market. The ECB, or I should say central banks, took up the rest. We think that this sort of activity will continue to extend. And if you move the slide forward, the current pace of the pandemic purchases is likely to extend in that upper left-hand chart through June of 2021. We don't think it ends there. We think that that sovereign issuance and corporate issuance will continue quite robustly through 2021 because of all the programs that are coming forward to support the economy. And we think it's quite critical that central banks will continue to step up. It could be another 500 billion, it could be more, and it will extend in time from our perspective. We also point, and I won't go into too much detail here on this slide, and we've got lots more behind this, that watching the trade-weighted euro is going to be pretty important as they sort of thread the needle, so to speak, between a potential reflation trade with implications versus deflation, Japanification concerns that are also, at times evident. So this is a space to watch with a very active and supportive ECB from our mind. Now, last but not least, I'll shift into currency, if you can move ahead. And here, what I would point to is that, clearly the election has been, quite critical from the standpoint of dollar and the dollar as it relates to, many other currencies. It seems at this point this morning, still unresolved as it is, that the center column here is what's in play. Biden wins the White House, but we've got a split Congress. And within that context, we do think that it is bullish to moderately bullish across a number of the G10 currencies relative to the dollar. And if you flip one slide forward, it's a few more details of some of our G10 currency themes and drivers as we look into next year. And I would just simply highlight a couple of details. And again, you can take a look at these slides in more detail at your leisure. But one is, we think that we're heading towards a global risk-on, risk appetite sort of scenario as COVID wanes as an issue through 2021. We think that that is a higher beta risk-on move that will play away from the dollar. From a Euro perspective, the European Recovery Fund, we think will underpin renewed confidence in the region. And certainly some of these more recent restrictions and lockdowns that are now being put in place will likely bolster the probability of the ERF being implemented successfully as we move into next year. The pound, I'd mentioned sitting here in London, is Brexit dependent in many ways. Thankfully, this decision is imminent. We can't go too much further than next week or the week beyond. We are hopeful on a constructive resolution. And as we look beyond that, which could be pound supportive, all else being equal, there are relative points of stress structurally that we do think will keep the pound sort of under wraps, especially as it relates to the euro. And last but not least, you can flip one more slide. It's kind of intriguing to take a step back a week or two ago and look at what the market sense of the dollar was heading into the election. You know, we do a regular survey, and the survey certainly, like a lot of other polls, had suggested a Democratic sweep, and that would be broadly dollar bearish. We'll be updating this survey in January once sort of the ground is clear, so to speak. And it'll be quite intriguing seeing what investor appetite or sentiment is from the European from a currency perspective at that point. And last but not least, final slide. I would just simply highlight what I've offered here is this little Cook's tour. Is only a tip of the iceberg of the research and data that we have within Bloomberg Intelligence. There is much more from a top-down perspective on these 4 strategy dashboards based on asset class, another 100 plus from an industry perspective around the globe. And, you know, certainly this is not a black box on Bloomberg. We've got a team of 300 analysts and strategists, and we would love to connect and are quite ready to help as you're thinking about positioning in the year ahead and beyond. So please do reach out. And with that, I'll bring my my comments to a close. So thank you very much.
Thank you for that, Tim. Now let's move on to our next session. I'd like to welcome Bloomberg News senior reporter for FX Rates, Liz McCormick, and Mike Pyle, the Global Chief Investment Strategist at BlackRock. Over to you, Liz.
Thanks, Dana, and thanks so much, and thanks everyone for being here. And Mike, great to see you again and getting up early with us today. And yes, we're going to talk about, appreciate it, Beyond 60/40. But before I get to that, Mike, as everyone in the last 2 days has touched on, of course, we don't know the net results of the presidential election yet. I know you all had a note recently. So just to save time, let's just say, as the media and the odds seem to be going, say we have Joe Biden as our new president in a split Congress. Could you just speak a little on BlackRock's view of the investment outlook, you know, fixed income, equities, if that were the case?
Sure. And I think what we've seen in markets the past couple of days provides some clues about what that environment would look like. You know, I think the big risk-on rally that we've seen is more than anything a function of just the uncertainty of the election clearing away. But underneath the hood, you know, the rotation that we've seen in equity markets away from the reflation trade, away from things like small cap towards those quality technology-oriented exposures that have, of course, performed so well since the start of 2020, as well as performed for a number of years. Those look as if they probably have some tailwinds in this environment, you know, because I think what a lot of investors were counting on to sort of see that rotation towards different leadership in equity markets was, you know, big fiscal stimulus, lots of public investment, that kind of reflationary push of the blue wave. In the absence of that, you know, growth will continue to be somewhat scarce. Technology companies provide a lot of growth over a long horizon. And when you combine that with the rally in bonds that we've seen, the expectation now that rates are going to be even lower for even longer, you know, that makes those long dated cash flows even more attractive. So and I think what we've seen, like I said, is a bit of a clue as to what the environment might look like looking ahead.
And so you've nicely kind of led us into our topic, which is about, is 60-40, that kind of old favored 60% equities, 40% fixed income, has kind of been brought into question in this, like you mentioned, very low rate environment. We did have the Fed yesterday who seemed to double down on, not tightening policy anytime soon. So can you first speak to why might that kind of, I don't want to say simple, but just, stick with 60-40 not be exactly working or the best in this environment?
Absolutely. Maybe it's worth just spending a moment on why 60-40 was such a cornerstone for so long. And it really was that it balanced all of the different objectives that investors might have. Obviously the 60% in equities provide that growth, that return to allow people to achieve their long run return objectives. But the bonds were a really important part of the mix too. Part of that for a long time was generating income, also an important objective. That's obviously faded away really since the GFC as rates have gotten ever lower. But what still remained was the ballast properties of bonds in choppy weeks or choppy months, like what we saw last week, what we've seen on a handful of occasions across the course of 2020, most notably, of course, in March. Bonds would rally quite significantly to offset equity market drawdowns and give investors a much smoother ride along the way. Now, what's changed? What's changed is government bond yields are now at historic lows and are primed to stay there for a long time to come. And that's a world where those ballast properties are just, a lot less capacious than they have been historically. In a world where the 10-year Treasury is trading at 75 basis points, there's just a lot less cushion in that interest rate to sort of really provide, really rally in the face of equity market drawdowns and provide that smoother ride. And so that's a world where what bonds are intended to do is less obvious looking ahead as it has been over the past 25 years, and finding resilience is going to have to be sought in other places.
Well, and of course, that was going to be my follow-up. If kind of the plain vanilla bonds, it's just not quite what it used to be, like you said. And I know you've written extensively on this. What are some of the other options? I like how you and your folks have called it trying to create a resilient portfolio. So how do we do that, Mike, in this new era?
Absolutely. Yeah. So I think the first point to make is there is no obvious direct substitute for what government bonds provided. That is, a very kind of unique financial instrument that provided a set of benefits and portfolios that aren't going to be able to be easily replaced. And so the important thing is to rethink about what resilience means. And the way we've kind of arrived at it is to say, boy, there are a lot of transformations taking place in the global economy. And whereas a resilient portfolio previously was about financial resilience, about recognizing the financial properties of bonds and making use of them to build resilient portfolios, looking ahead, resilience is going to have to be much more of a real economic concept, and to sort of build diversification, robustness in portfolios on the basis of some of the transformations we see in the global economy. I'll take two examples. The first would be deglobalization. I think we're moving from a world that was on a steady one-way journey towards greater integration, towards, importantly, higher correlations across different parts of the global economy, as a result, higher correlations across different global markets, which basically meant, international exposures were a nice to have, but not necessarily a must have. But in a world that's deglobalizing, in a world where the constituent pieces of the global economy are becoming less correlated with one another, and as a result, global financial markets are becoming less correlated with one another, being really thoughtful and intentional about building geographic diversification into portfolios is going to be an important part of what it means to build a more resilient portfolio. In particular, harnessing the two big growth engines that we see in the world over the next 10 to 15 years, the United States and East Asia, and being pretty thoughtful about how you get exposure to those two growth engines is going to be important both for return, but also, again, kind of given the lower correlations across the two of those looking forward, and building some of that balance and resilience in as well. The other, just quickly, but very importantly, is sustainability. This to us is an important dimension to think about risk in a portfolio looking ahead, whether it's climate risk, social and governance risk, what have you, but also importantly, a way to think about return in portfolios. And we've written extensively about the degree to which we see important trends that are going to leave sustainable assets to outperform over the coming period of years. And so those are two that we think are an important part of how you get the return you need, but also given the nature of risks looking ahead, deglobalization, the sustainability revolution, an important way to think about building resilience into in a world where government bonds may not do the trick in the same way.
Mike, one of our participants had sent in a question and asked, in this world where, we're trying to look at other things besides government bonds, someone asked, do derivatives play a role in a balanced, or call it, like you say, resilient portfolio? And if so, how so? Could you talk to that a little?
Yeah, I guess I don't have an immediate answer off the bat. I would say that's something that kind of every investor is going to have to think about carefully. I guess our broader thought would be, we think there are ways of building resilient portfolios using kind of, physical exposures without kind of needing to derivative exposures. And so to our eyes, building those portfolios with kind of basic building blocks that are out there should be achievable without having to resort to other exposures.
And you kind of touched on this a little bit. Another question that came in is, in this schema, can you have like sustainable returns? And I know you touched on it, but do you still, a lot of people say even the U.S. government bond market has such good returns this year, you'll never see that again. But with this new schema of portfolio balance, you don't just see this as safe, but you can with, like you said, maybe sustainable assets, private markets, and things that you've written about still have good, solid, sustainable returns, Mike?
Yeah, I think the theory that we're sort of really advancing here is that, we're stepping into a world where growth is likely to be scarcer looking ahead. And so really identifying the sources of growth in the global economy and building portfolios that can harness that in a diversified and differentiated way is really at the heart of resilience and the heart of what it means to transition out of the 60-40 into something else. We've talked about, geographic diversification. There are going to be a couple of pockets of the global economy, the U.S. at the top of that list, that are going to continue to be engines of growth, and being sure in a global portfolio you're getting access to that in a significant way is going to be key to return. To this point around private markets, as we've seen the way that companies finance themselves, assets get financed, transition over the past couple of decades, from public markets to private markets, accessing sources of growth that are increasingly financed in those markets is going to be an important part of getting access to different slices of growth in the global economy as well. Same too about sustainability. So again, yeah, exactly right. It's about kind of identifying where those sources of growth are going to be in a growth scarce world, and building portfolios that are balanced across those different sources, recognizing that, again, for reasons of deglobalization or other, that they're going to be less correlated with one another than they have been in the past.
Now, let me come to what you've touched on. It's kind of near and dear to my heart since I write a lot about it. And the Treasury, even though maybe we're on the cusp of this massive dose of Treasury issuance peaking, we don't know. They raised it again this quarter. But is there still a role for government bonds, Mike? And what is it? The Treasury still needs to sell them. All these governments are selling them with all this fiscal stimulus. People are buying them. They don't, even though some yields are negative even. But, what is the role of government bonds if it, as you said, has shifted a little bit in the way people are using them in portfolios?
Yes, I'd make 2 points. One, the story that we're articulating is a story of relative shifts, not absolute shifts. Of course, there is going to continue to be a role for Treasury bonds in a resilient portfolio. It's going to be a lesser role than it has been in the past, but there's still a core role for those bonds as stores of value, and also importantly, of course, as risk mitigants to some extent, even though we can expect fewer risk mitigating properties in bonds looking ahead. The other point I would make is, one of the core parts of our narrative as well, which we haven't touched on, is the extent to which part of that story is about reallocating your exposures within government bonds. In particular, we have a view that the Fed is likely to be successful looking out over the next, 5 to 10 years at achieving its goals around overshooting inflation beyond 2%. And our forecast is that inflation after 2025 should be able to get to that 2.5 to 3% range in CPI in the US. That's a different world than the one we're in right now. And as a result, we think places like TIPS are a really good exposure to be building in the here and now, while markets aren't pricing that likelihood over the medium term. And that can be another dimension of resilience in portfolios, building diversification and robustness against the possibility, we think likelihood, that the Fed is going to be successful at achieving a different inflation environment than the one we're in today.
And Mike, I assume that might include, if you think the Fed will be successful on inflation, maybe if you're in nominal treasuries, deciding very closely where you go. Though it's been ebbing and flowing with the election, but if inflation rises, maybe the curve will steepen and that type of thing, picking your point.
Yeah, I think that's exactly right. I think that the sort of single biggest decision is the two single biggest decisions are what you want your overall allocation to bonds to be, and then what you want your relative allocation within that to be to nominal treasuries versus TIPS. But beyond that, I think there are important tactical calls about where on the curve you want to position your government bonds. I think in the lead up to the election, for example, and the expectation that there might be a blue wave that could lead to significant fiscal stimulus. As a result, the curve could steepen somewhat. I think a lot of investors were saying the front end of the curve is a more sensible place to seek out what government bonds could offer. I think now sort of seeing that that scenario kind of come off the table, I think it's safer to be somewhat further out the yield curve, just in the sense that the trends we've seen for the past 8 to 10 years around curves on balance flattening and staying relatively flat seem like a more comfortable set of assumptions in a world where that big reflationary push is just quite a bit less likely.
Mm-hmm. And one thing someone said to me earlier this week is that once we get clarity on the election, the Fed and other central banks seem to let us know for now what they're doing. A lot of it is, how the economy goes is how the virus goes and the vaccine, and which is quite a difficult environment. I have family members calling me, what do we do? It's hard to explain. I'm sure you talk to a lot of clients in the environment where we are seeing a rebound, but it depends on the virus and shutdowns. How do you kind of speak to people and clients of just kind of keep calm, or how can you kind of invest in this world?
Yeah, so I guess I make a couple of observations. First, I would say we are concerned as watchers of the U.S. and global economy, as investors, around some of the trends we're seeing around the emergent wave of infections here in the U.S. and certainly in Europe. That I think points the way towards a period of the next few months that could be difficult ones for the economy. You think about kind of the confluence of three things coming together. One, a restart that was already, slowing, that the kind of fastest part of the restart was behind us. It was going to be much more of a grind from here, combined with the likelihood now that we're not likely to see as much policy support on the fiscal side looking ahead. And then third, obviously, these kind of reemergent public health challenges with the virus. Those three things coming together, I think, point out that this is going to be a period of months of some peril for the U.S. economy before we get into 2021. And then hopefully, as you said, we get more positive news on a vaccine. We get positive news on timelines around manufacturing and distribution. And at that stage, more positive news around when we can expect to see a genuine kind of renormalization and restart of economic and social activity. So, I think that you're exactly right, that, there is a way of kind of looking ahead to 2021 into the spring and summer and seeing a world that is rapidly normalizing. But between here and there, we still have another bridge to cross, and it's not obvious that policy is going to be there in the same way it was in the spring to help us, get across the chasm.
And a lot because consumers are a huge chunk of the economy, right? Is not just on official lockdowns, is when the consumers, and I guess you just can't know that, feel comfortable to go out and spend or, interact in the economy, right?
Yeah, exactly. I mean, I would say we're seeing changes in behavior, now versus where we were in the spring. So I think, we're seeing globally in Europe and the US, elsewhere, a greater willingness of consumers to kind of maintain a degree of mobility, maintain a degree of engagement and kind of commerce and consumption in a way that wasn't true in the spring, which we think reflects, generally, a set of kind of practices, mask wearing, what have you, that's giving kind of consumers greater confidence that there's some basic level of normalcy that they can maintain in a way that people just had a lot less confidence in the spring. Right. The thing I will say is, you look at economies in East Asia, which have had a very strong restart. Partly that's a function of the really robust public health response. Yeah.
I'm sorry. I knew we'd run out of time. We're getting to our time, so I'm going to have to stop you there and say thank you so much for chatting with us. Thanks everyone for joining on our, this live event. Markets, Navigating Markets 2020. You can keep the conversation going on social media at Bloomberg Live, which is on Twitter and LinkedIn. And we want to just thank everyone. A big, big thanks to our sponsor, Swissquote Bank, for making this possible and everyone spending their time with us. Please keep the conversation going. We're sorry we couldn't be there to see you live, maybe next year, but it was a lovely day, 2 days. So thank you very much, and stay safe and well.